Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let's move on here. Okay, now here we have, just to show you again the value of candles. This is a bearish Western signal, and it's called a descending triangle. We have support, horizontal support pretty much, and lower highs, all right? But, now I'll show on the title here, one of the best ways to make money is, drum roll please, okay? We should not be selling because of these bullish engulfing patterns. So one of the best ways to make money is not to lose money. So here, for those a little bit more aggressive, although this was a bearish Western signal, a descending triangle, one of the things, and again, let me turn it over to Steve. Let's say we wanted to buy very lightly here, all right, on this bullish engulfing pattern, but we wanted to really increase our exposure on the upside as soon as it got above this trend line over here. Okay, and my minimum target would be over here. So, what would we do here to go lightly long? In other words, not an aggressive bull option trade, and then getting more aggressive on the breakout.
Simply putting on the call spread and then taking off your short call as it breaks through.
Right. Okay, like the opposite of what we did with the bear put spread, and just like
exactly.
Right. Okay. Mm-hmm. Great.
So you could do that, and then now you just have a long call, and you're sitting with that as the market rallies. Let's say it gets up to the high here. You're a little concerned as it retraces, but again, obviously, as this runs, now you're going to see the benefits without any sort of upside hedge. You're going to participate in the market all the way up. And until you see another candle, that might work very, very well. So again, if you're very, very aggressive, you're just going to want to be long without any hedge. So a single call is going to be your best way. But you don't know that this might not continue sort of a neutral trend for a while. You keep the call spread on until it breaks through your breakout zone.
Okay, now let me ask you. So let's say we're long the call here. And we're going to look at this pattern in a minute, but it's a bearish engulfing pattern, the red wrapping around the green. So you get a little bit nervous, but you're still longer-term bullish. Would you then sell a call to protect yourself? Or
that's probably what you would do. You probably could buy it back here, then sell it back out again. Now you're confident, and it moves back down, but you're not so concerned. In fact, you almost expected that.
Right.
And you have your sort of a position that's going to do okay in a neutral market. But again, and I think you're going to, I'm going to jump ahead of you, but more than likely, I guess, you might be covering that short call somewhere in the breakout zone. Is that how you play that?
Right. And actually, I guess by selling the call, it worked out well because he would have picked up some time value over here, right?
And also, you didn't panic out of your long call.
Right. Okay. So, that's why it's great, going back and forth with Steve to get all these little nuances, so to help you, really use this information from the candles in, real-world option trading. And as I had mentioned before, we are going to segue into the bearish engulfing pattern, and we'll be, going on another 15, 20 minutes or so. So it's a black real body that wraps around the white real body. The bears, obviously, taking control from the bulls. So here we have a case, and this to me is a really high probability short sale. So we have a bearish engulfing pattern, see the black or red real body wrapping around the green, a doji. Now this is just a great example of the power of candles. This tall green candle where the market opened here and closed here, very strong momentum obviously. Bulls are very much in charge, very vibrant, very healthy market, and in one session, everything had changed, the doji, the infamous doji. So the market has gone from up to neutral, and then we got the coup de grace with the bearish engulfing pattern. So this to me is a great short sale. I'd have a stop up here, okay, above the recent high. It's not. I don't think this may not be quite a shooting star because the upper shadow has to be twice the height of the real body. But have a stop here. My target would be in that blue line. So I guess this is even just a long put, and again, maybe protect yourself as it's moving down by legging into a spread, but long put on that.
Yeah, long put, and in fact, like, as you said, if you put on the put spread, the reason I even like the put spread is that because the first couple days you're doubting yourself. Oh boy, it didn't break.
Mm-hmm.
So you have the first week where you're basically unchanged. If you have the put spread, in my humble opinion, you're not as nervous if you're long the put, where you might stop yourself out. So the put or the put spread, if it rallies a little bit in your favor, you sell put. You have a week where you're comfortable, and then now you're in a position where you might even want to cover that short put again because now it's confirmed.
Right. Mm-hmm.
You're right, and then you might be more aggressive again.
Right. Now, again, I'm just getting up to speed on options, but you could do a bearish call spread also, right? Instead of right. And what thought process should one go through between thinking about a bearish put spread and a bearish call spread in a situation like this?
That's a great question, Steve. It's really the option pricing is about the same. Mm-hmm. Some people prefer to do the credit call spread because you take money into your account.
Oh, okay, I got you. Mm-hmm.
So let's just look at it. Let's just say it's a $4 put spread or call spread. One might be that you pay to. The other is that you receive to. Mm-hmm. And some people like that they're receiving it. Mm-hmm. There's a little bit of an option pricing discrepancy, so it's not as easy as that. It might be you're paying $1.95 or something like that. So you're actually going to get a little bit of a break there when you buy the spread, the put spread, rather than selling the call spread. But based on risk reward, they're essentially the same. And the way I teach the credit spreads and the debit spreads, I try to remind traders/investors that they should do what they feel comfortable with. I actually like doing the put spread. I feel there's a little bit of better pricing on that. But if you prefer to do the credit call spread, there's no disadvantage there either.
Great. Okay. Thanks. All these little nuances, so it's good to hear from the expert.
Thanks.
Okay. So here we have an example of a bullish engulfing pattern and a bearish engulfing pattern over here. And by the way, let me go back to this one because one of the questions I did have in my notes, Stephen, is would we do? Let's say we did a long call. Let's say a long put. Would we do and our target is down here? Would we do an in the money or an at the money or out of the money? I know out of the money is lower probability, but it's a higher percentage. So what's the thought process we would go through if we sold it here? And we're pretty confident our stop is here and our target is here as far as, in, out, or at the money.
The way I teach it, the out of the money option is a more levered approach. So if you're going to raise your hand and admit that you want more leverage, that you want to take more risk, but you're pretty confident, you want to be buying an out of the money put. You can buy more of them. Mm-hmm. So if this is, the way I like to look at trading is you rank your scenarios, you rank your chart setups, and if this is the best chart setup you've seen in a number of weeks, months, or maybe even years, you probably want to lever up. But if this is a more typical trade that you see each and every week, I don't think you want to use leverage because leverage is a double-edged sword. It can really hurt you if you're wrong.
Right. Great. Okay. Thanks.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.